Michael Burry, a famous billionaire predictor on Wall Street, he once predicted that the stock market would continue to fall from November 2021, and the performance of the market fully verified his statement. Recently, Twitter laid off 50% of its workforce, and Google and Meta laid off 20% of its workforce because all the companies are hiring freeze. This big short investor, Michael Burry, continually sent 3 posts warning that 2023 will be even worse than 2008. In this video, we take a look at Michael Burry's predictions through the most real data and what exactly will happen in 2023. Is the economy going to be going really bad? Michael Burry gave an early warning of the coming 2023 crisis on October 2022, arguing that the financial crisis in 2023 was even worse than 2000, the dot-com bubble crisis, and he believed that we are repeating a phenomenon similar to the dot-com crash of 2000. The reason for the 2000-year dot-com bubble crash was that all internet companies had risen to insanely high valuations before 2000 because people thought that they would never fail. However, the actual profits of these companies were not high, and by 2000, the dot-com bubble burst. And a large number of internet companies collapsed, including Amazon's valuation losing over 90% at that time. However, there are many current companies show the same signs as they did in 2000. Michael Burry thinks that we have a lot of technology companies that have gone to insane valuations over the last few years, but now they are going downhill, and that decline affects other types of companies as well of the force. Michael Burry argues that the difference between present and the year 2000 is that year 2000, people were actively investing, while today people are passively investing. Passive investing means that whenever you get paid, your income is automatically invested in a number of different ETFs or index funds or whatever. And many technology company employee salary packages are executed according to this strategy. So the passive investment bubble has been expanding for the past decades until this year gradually burst and continue to fall. Why is 2023 worse than 2008? The data tells you. What is the basis for the big bears to dare to give such an early warning? What will the collapse of 2023 manifest in? Asset bubble crash. The total value of the US housing and stock markets is now more than 80 trillion, which is crazy given that the total GDP of the United States is only 25 trillion, while the total value of assets is 3 times that of 2008. But the size of our economy suggests that there is a high probability that we will experience a market crash next, in particular for shareholders, in particular for stockholders and homeowners and those with large amounts of assets. These groups of people hold as the Fed continues to raise interest rates, the value of assets will gradually decline. We should understand that many of the existing fixed assets in the United States are based on artificially regulated low interest rates, and interest rates have been falling continuously for the past 3 or 4 decades. Interest rates were even close to zero in most parts of this pandemic, which is where asset price bubbles come from. Therefore, interest rates and asset prices are changing in reverse. The more interest rates fall, the more asset prices rise. Now that interest rates start to rise, then we will see asset prices fall. Let's look at the ratio of asset prices to GDP. Asset prices divided by GDP, which is the ratio of asset bubbles. It can be seen that although the current ratio, 320%, is lower than the 380 6 months ago, it is still not only higher than the peak of the 2007 bubble, but also higher than the peak of the 2000 bubble. So at the moment, we are still in the biggest asset bubble ever. As a result, house prices and stock prices will take a long time to get out of the bubble. The Fed's rate hike has only led to an initial drop in asset prices, and now it is just the beginning. While unemployment has risen after the Fed's multiple consecutively rate hikes, a big recession is coming. The second is the problem of the energy sector. Oil prices have fallen a lot over the past few months, but have recently started to pick up as the OPEC has announced that it will cut production by 2 million barrels per day. So gasoline prices could rise in the following months, which is a big problem for the US economy. US consumers are almost out of savings, and the statistics we've seen on credit card debt and the US personal savings rate all suggested that Americans are running out of money. The personal savings rate is used to indicate the economic situation of an average American household and is also a bellwether for forecasting the economy. In the past months, the average savings rate of Americans was 3.5%, well below the average savings level of nearly 8%. And the current savings rate is almost as low as the 3.2% before the financial crisis. Although a low savings rate is a sign of a recession, it is good for reducing the inflation. The less people save, the more they have financial difficulties and cannot afford disposable spending. People cannot afford stuffs. The price of these consumer goods will come down, and the inflation will come down too. In the long run, this will also bring down the federal funds rate and the mortgage rate. So what can we do for the current warning from Michael Burry? The first and most important suggestion is to keep cash in hand, which has always been one of the most stable assets. Although inflation remains high, the dollar market has performed much better than the stock market. At the same time, cash will give you more flexibility in life and employment or even investment. In addition, please remember, don't make investment that you are not familiar with. For example, do your research to see if there are some opportunities to invest. If you are not familiar with stocks, then please do not invest. If you made a profit in real estate in 2008, then this time please prepare your cash and wait for the good time coming. Finally, with a saying from Michael Burry, the key to be a successful passive investor is that you have to invest for the long term, not the short term. Actually, it's same as what Warren Buffett said as well to all the investors. So here we also want this information give you some takeaways and will help you to see how you're gonna invest your money. And for the long run, especially for 2023, be careful about how you invest. And my suggestion to you is that hold your money, hold the cash, and when you see a really good opportunity, then jump in. It's always not too late to invest. Thank you for watching. We'll see you next time.